DoubleLine Chief Executive Jeffrey Gundlach says this recent surge isn't getting enough attention. He tweeted yesterday yields on the march. 10s above 3% again, this time without financial media concern. Watch 3.25% on 30s. Well, too close is above, and he says equal a game changer. So is Gundlach right, and is a move in yields not getting enough attention? What's next? Well, joining us now is John Bilton. He's head of global multi-asset strategy at JPMorgan Asset Management. We do give it enough attention. We're giving it right now, John. What do you think it means?
Absolutely. Well, look, I think what it means is a couple of things. First and foremost, I mean, the 15th of September was a subtle shift in the tax rules out in the US. Some of the pension fund buying that we'd seen going on during the course of the year, potentially hitting a little bit of a sort of bump in the road. But let's be clear, what's duration giving you at 3 and change on the 10-year note? It's giving you a great portfolio hedge. You know, stocks have surged this year in the US. What does that mean? You know, you may, if you're a pension fund investor, be choosing to want to de-risk parts of your portfolio above 3%. That's actually giving you, in the 10-year note, more than 90 basis points of real yield. You're being paid to de-risk. So the idea that I think that, you know, all of a sudden we've got a technical breakthrough 3% and we surge on upwards, I don't necessarily see that, because global growth remains above trend but muted. Inflation is still reasonably contained. The Fed are very clear in terms of where they're going with their rate hiking, and we've still got this issue of trade. So there's still plenty of reasons to want to be overweight duration if you're in a balanced portfolio.
All right. Should the Fed actually see themselves more as central bankers to the world? Should they look at emerging markets and look at dollar levels? Because it's a loop, it's a catch-22, right? The more the dollar rises, the more it hurts a lot of these emerging markets with debt denominated in dollars.
Well, I mean, let's be clear. I mean, the dollar seems to be stabilizing in trade-weighted terms. It dipped down on the DXY index to about 89. It's sort of risen back up through 96, now hovering around 94. As we see it, it's maybe 10% undervalued relative to long-term fair value, but you know, currencies, you know, can jump around a fair amount. I think that the Fed do take seriously their role as central bankers to the world. They look at financial conditions, but right now, with stock markets, you know, reasonably supported in aggregate, and especially in the US, credit spreads still reasonably tight, and you know, borrowing rates around the world, if we look outside of the US, still pretty close to zero. You know, it'd be hard to argue that financial conditions are a constraint on the Fed today. It doesn't mean they're not going to tighten as the Fed continue to go, but I think right now they are still looking at the domestic economy, tight labour market, and thinking, you know what, we're doing the right thing. We're moving 1/4 of a point roughly every quarter. That's probably the right trajectory for us.